Okay, you guys, I thought we'd take a look at another one of the cash accounts that I mentioned earlier in the chapter, petty cash. And this one's on page 409, exercise 7-27. Locke's company established a $200 petty cash fund on October 2nd, 2016. Now, let's talk about what, I'm sure you probably know what petty cash is, but it's literally cash kept in a box somewhere at the office or the place of business, usually a lock box or a locked box. And you only give a key to, maybe you as the owner only keep a key, or you give a key to trusted employees, people that you want to have access to petty cash. And we use it to buy really small ticket items. I mean, we don't want to be purchasing a box of Staples for $1.57 or $2.39 with a check. Because checks cost something to themselves, they cost something to process. Lots of times small checks don't get cashed very quickly, so you're also paying someone to do the bank reconciliation, and they're having to carry over that $2 and something check every month as outstanding. So the $2 check can end up costing you quite a bit more than $2 after a while. So we'll buy these small ticket items out of petty cash, stamps, things like that. So they established the petty cash fund on October 2nd. The fund is replenished at the end of each month. At the end of October 2016, the fund contained $37 in cash and the following receipts. Well, what you would do, anytime you take money out of petty cash and buy something, you put the change and the receipt back in the box. That way, at any point in time, the owner can count cash in the box and receipts in the box and come back to the amount that's supposed to be in petty cash, in this case $200. Now, if you're the owner, you would want to do that periodically and kind of at random times in front of everyone in the office, or at least in front of everyone that has access to petty cash. If you take it back to your office and count it, and it's short, then your employees might think you kept some of it, right? But if you count it in front of everyone, well, then they know you're keeping check on petty cash. It's an easy place for employees to borrow or steal from you if you're not paying attention. Also, I said count it periodically at random times during the month. That way your employees don't know when you're going to count it. So in case they're borrowing out of it, they don't know when they have to have it back. If you count it every Friday morning at 10 o'clock, well, that's just as good as not counting it, because your employees could borrow on Monday. As long as they have it back in there by Friday, they know you'd never catch it. But what we do, the entry to set up petty cash on October 2nd, we'd set up a new asset account, and there'll be a separate general ledger account for it, petty cash. Now remember, this would be included as part of cash and cash equivalents on the balance sheet, and we debit that asset to increase its balance $200. And we'd probably write a check out of our regular cash account to set it up. So we're going to credit cash to set it up. Easy enough, right? Okay, and then we have the following receipts. Now, I would like to go through and add this up and make sure we're not short or over. Okay, so we got it says at the end of October the fund contained $37 in cash and the following receipts. Well, if we add the $37 in cash and the receipts together, we should come back to $200. So 20 plus 19 is 39, plus 48 is 87. Plus 76 is 163. Plus 37 is 200. Okay, so we're good. Alright. So for each of those items, we're going to debit either an asset or an expense account. Here I think we're just going to use expense accounts. So on October 31st, we're going to debit office supplies expense. That's assuming those supplies got used during the month, and that's what your textbook assumes here. We'll debit a lunch with a client. I'm going to call that entertainment expense. $48. Alright, then we've got postage expense. For $20. That could get grouped with the next one, miscellaneous, but they separated it out here. Miscellaneous expense. In this case was 19. Now, you would probably think here all those items got paid out of petty cash, so we'd credit petty cash. But instead, you guys, we're going to credit the regular cash account for that total, which I believe was 163. It was. Plus the 37 gets us back to the 200. You might be wondering, why do we credit the regular cash account? Well, we're going to write a check for that amount. In the memo section, we'll write to replenish petty cash. And then we'll go to our bank, cash that check, put the 163 back in the box. So the petty cash stays on the general ledger all the time at 200. Anytime we want to check it, we count receipts plus cash in the box, and it should come back to the 200. It's a really important account to have some internal control over. Like I talked about earlier, you want to count it periodically and in front of everyone who has access to it, just to make sure someone's not stealing from you. Now, I don't know, someone's borrowing $10 out of petty cash, maybe you just reprimand them and keep them on as an employee. Maybe you go ahead and fire them. It'd be up to you as a business owner. I don't know, I tend to think if you put up with a little bit of theft out of an employee, then maybe it's not their fault, it's more your fault if they end up taking a lot of money from you. It's just my opinion. I don't think you'll have any trouble with the exercise 7-27 on the Connect Plus side after working this one with me. If I can help you, let me know. Thanks.